Welcome to Traders Corner. Joining me, as always, is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, lots of charts to get through this evening, so we're going to start off the S&P 500 as we usually do. And I suppose it's all building up to next week's futures closeout for our own market. So there's quite a lot of influence that we need to pay attention to.
That's right. The chart of the S&P 500 is up on the screen at the moment. Last week when we were here, I pointed out the fact that we had actually seen a daily reversal on that market and that it looked as if we were due for some consolidation to begin on the S&P 500. And that is what's happened. You can see that market's been chopping around in a relatively sideways to slightly downward fashion over there. So that looks like a healthy bit of consolidation that's underway there. You can see also the stochastic oscillator has moved off of overbought territory rather, and it seems to be coming down. So my expectation is that we can probably expect a little bit more consolidation here in the near term, but do also keep in mind that if we do get a Santa Claus rally, which often happens probably in the last 2 weeks of December, if it's going to happen, then maybe this consolidation tees us up for that, potentially. Although I never like to hang my hat on a Santa Claus rally, I mean, just because it's a nice term doesn't mean it always happens.
Yeah, I mean, it has happened, admittedly, for the last 7 years or so.
Yeah,
so
it is quite a common occurrence, so I guess you'd be brave to bet against it.
Yeah. As for the top 40, if there's consolidation in the S&P, do you think it's going to have much bearing on our own index? And this, of course, is very important for us because we've got this option structure which closes out next week.
That's right. Well, let's quickly have a look at the technical structure on the top 40, and then we'll talk about the options after that. So if we have a look, it's quite clear that this top 40 market has been trading in this downward sloping channel over the last 3 or 4 months or so. What happened yesterday was that we actually got a daily reversal up off the bottom of that channel. But having said that, today's trading action is pretty weak again. So it remains to be seen whether we move up off the bottom of that channel and have a little bit of a short-term bounce now, or whether we just continue to dribble lower. Overall, that structure is still quite bearish, I think. And what gets me a little bit concerned is if we have a look at the options interest, or we call this the optionality in the market, as things stand at the moment. What's very, very interesting to note is that there's an extremely heavy concentration of put options at the lower levels here. If you have a look from 43,500 all the way down, at every 500-point interval on the way down, there's quite a significant open interest. 43,000 has got nearly 12,000 put options open there. 42,000 has got almost 17,000 puts open at that level. 41,500 has got close to 13,000 puts. Now, if you keep in mind that every one of these put options is effectively an exposure of around about, give or take, 420,000 rands worth of exposure, it's quite significant. I've actually seldom in the past seen a market that's poised like this just before a futures closeout. Usually you get some degree of offset of puts and calls. But at the moment, all the call option interest is right up at the higher levels, above 45,000 on our market, which is a long way away from where we are at the moment. So I'd be extremely surprised if any of those call options come into play by the time we get to the futures closeout next week. But these put options are very much in play at the moment. And the reason it interests me so much is because typically if you've got written put options like that, and typically you would probably find that your banks may well have written those put options. A put option, if you're a writer of a put option, effectively you're selling somebody else the option to sell the index at that strike price if the index ends the quarter below that strike price. Now, in order to hedge your exposure, what typically you need to do is if the market begins to move lower, you become a forced seller of futures in order to hedge yourself. Because if you know that you've given somebody else the option to sell at a strike price, indirectly then as the writer of that option are forced to be a buyer at that strike price on expiry. I know it's quite complicated, but bottom line is that if you're a writer of options and the market begins to trade lower, like it seems to be doing here, you would want to hedge yourself against being exercised on those options, and to do that you will sell short futures, sell short top 40 futures. So the risk as we approach the futures closeout next week is that any further selling pressure could suck in more options-related selling pressure into the market, which could exacerbate any move to the downside.
Yeah, and I suppose at a certain point, this wouldn't have been bad for us, but now the market is trading in your sweet spots for your option structure. So if it falls much further, is that a bit of a worry?
Yeah, it's not really a worry. It's just that we would make less. This payoff profile on the right-hand side here is just a very crude indication of the type of payoff structure that we have on our options. So the sweet spot, the optimal point for us is if the futures closeout ends at 43,000, okay, which is more or less close to where it is at the moment. Then we would make our maximum profit on this option structure. Below 43,000, the profitability of that structure begins to erode, and above 43,000, the profitability also begins to erode. So I would be happiest if we ended the quarter somewhere around about 43,000. But remember, the futures closeout happens on the 15th of December. That's next week, Thursday. It's 8 trading days away from now, including today, which is a long time in the market. A lot can happen in 8 trading days. And one of the things I probably am fairly certain of is that it probably won't be at the same level that it is now come next week, Thursday. Anyway, it doesn't really matter whether it's higher or lower from here. We will make some money on that structure, which is nice. It's just that where we are at the moment is where we actually make our maximum profit.
I mean, it is nice to see that the structure has worked and is working.
Very much so, yeah. And look, I mean, I know a lot of people out there are probably saying, well, why don't we just close it out right now? The reason being that it's not as simple as that. When it comes to trading these options, there's all sorts of other complexities that go into pricing of options, volatility, time value, et cetera, I can't just close it out and realize that profit immediately. I actually need to run it out to expiry, or alternatively manage the delta, we call it, the delta being the futures positions that I've got against the options. And I need to manage the delta around that structure.
Just very quickly, Garth, before we get into this week's trades and also Kumba, would you consider going short of the market heading into next week if it does look shaky?
No, I don't think I would. I think I'd just be happy to leave it like this.
Okay. Yeah. All right. A stock that you've been long of the last couple of days is Kumba. Well, 2 weeks now. And it had a wobble, then kind of recovered. So are you still in there? Are you still in the money?
Yes, we're still in. We still are in the money on it. It hasn't rocketed higher as quickly as I thought it might, but nevertheless, the trade is still working for us. So what you can see there is the structure that got me into Kumba in the first place was this little triangle pattern, which is quite evident there. Typically, a triangle pattern will have 5 waves and it'll break out on the 5th wave. So here you can see them quite clearly, 1, 2, 3, 4, and then it breaks out on the 5th wave. And typically, you'll then take the height of that triangle at its broadest point and project it up to give you a target. Now, we were relatively conservative here, and we're looking for a target of about 180 Rand. Now, it hasn't got there yet. It's been as high as 175 Rand, and it seems to have gotten stuck at that area. And you can see on that chart now, as indicated with that little dotted line there, 175 Rand now appears to be offering lateral overhead resistance for the stock. So it probably needs to break above 175 in order to open further upside for us. But anyway, look, we still are in the money. We're long of 400 CFDs from 162.50. Our stop loss is 155. That stop loss has not been challenged at all yet. We're looking for a move to 180. But I suspect if we did get a move above 175, it would probably be bullish for even further upside beyond 180 Rand.
Yeah,
but
I suppose the problem is that you've got to actually close out your trades in order to hopefully make a charity donation in the next 10 days.
Yes, well, exactly. That's it. We've got to shut up shop fairly soon. So I'm going to need to close out this position probably in the next week or so. I'll obviously try and get as much as I can out of it. But realistically, I'm not sure that I'm going to get to see it reach its target before we have to take profits on this trade.
Yeah. Well, good thing that Kumba had a good day yesterday, and so did Exxaro. And this is the trade that you've entered into the portfolio. And it's an interesting one because there's a lot of elements to this.
Yes, that's right. It is interesting. And I'm going to talk about understanding a 3-day rule trade here. Now, we've done this on the show a couple of times in the past, and it's something I often look for, is the 3-day rule. So understanding the 3-day rule basically works as follows. If you get some sort of shock event that comes along into the market which was not expected, typically it takes about 3 days for the market to digest that news, and usually markets do overreact. Particularly they overreact on the downside. And very often when you get an overreaction like that, by the time the 3rd day rolls around, you usually get some stability and then a bit of a snapback or a retracement of the losses that the stock might have taken. Now, in the case of Exxaro, what's very interesting here is that Anglo-American owned almost 10% in Exxaro. And last week they made an announcement that they were looking to exit that stake in Exxaro, and they did it via an accelerated book build. So an accelerated book build is where a shareholder will go to a bunch of investment banks and say, right, we have this large block of shares, we need to get rid of it. You have access to all sorts of clients, be it pension funds, hedge funds, institutions, whatever. Here are the block of shares, we want you to go and find a buyer for it. And it's quite a common thing to see in the market. But what typically does happen is that you'll find that the share price does need to drop quite dramatically in order for you to find buyers that are interested.
Yeah, because they've got to take up a big chunk of stock in a very short space of time.
That's it. It's the simple laws of supply and demand. If there's a lot of supply of something, then the price is likely to go down. And that's exactly what you see in the case of a book build like this. So what happened with Exxaro is it was trading around about 100 Rand per share before Anglo American announced that it wanted to exit this stake. On that book build, the share price dropped very sharply. Eventually, the shares were placed at 87 Rand per share.
Yeah.
And it was placed overnight, very quickly, very clean, and these book builds typically do work like that. The shares are placed within 24 hours. It's amazing how much appetite there is out there in the institutional market for stock when it's placed at a big, deep discount like this. But the reality is that nothing's changed at the company. If it was valued at 100 Rand per share and the market deemed that to be a fair price for the share before all of this, well, then nothing fundamentally has changed. So realistically, that is probably still a fair price for the share. But the reason it drops so dramatically, like you see over there, is because you've got this short-term overhang of supply. And the 3 days pass, and typically, if you have a look here, you get 2 days of very heavy selling, and then on the third day, you get some stability. And often the other telltale sign is a very, very heavy volume spike, as the case is here. So the key is wait for the third day. Don't just rush out and buy on the first day. Wait for the third day. Look for that stability to enter the market and then do the buying.
Yeah, and you have entered that trade.
I have. I've gone in at 85 Rand 50. So if we unpack the details quickly, I'm long at 85 Rand 50. Stop loss 81 Rand. That means my risk per share is 4 Rand 50 per share. I'm risking 3,090 Rand here, which is 1% of our capital. 3,090 Rand divided by the risk per share of 4 Rand 50 gives me a figure of 686 shares. I'm rounding that up to 700 CFDs. My target, as I said, is 94 Rand. Risk to reward ratio here is 1 to 1.88. So it's a decent risk to reward ratio. And I'm hoping that we can get some of the profit out of this trade before we have to close up the year and end it on a high note.
Yeah, and I mean, talking of a high, the portfolio is at a high, isn't it? For the
It
year?
is at the moment, yeah. That's the portfolio as it stands at the moment. So you can see we've got 311,000 Rand in our account. That's up 24% for the year to date. And there you got our most recent trades in Exxaro and Kumba. And then up at the top there, those are the options positions that we've got. And then we've got some 5 All-Me futures, which is a delta hedge against our option structure.
Right, so it's going to be very interesting to see what happens in the next 7 or 8 trading days.
Yeah.
Garth, I hope it all works in your favor. And just to end off with a reminder, well, for the rest of the year, and there's only a couple of shows left, that you can subscribe to a weekly email. That's
right. We'll send you a weekly email if you are interested in what's coming up on the show each week. Go to traderscorner.co.za, go to the section where it says free weekly email. You can enter your email address, and we will then add you to the list to subscribe you to receive whatever content is coming up on the show during the week.
Okay, and only a couple left for the year, so make sure they watch them. Garth, thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.